If you've been wanting to learn how to collect premium income from the stock market, whether the stocks are going up, down, or sideways, today's video, I've got a challenge for you. In today's video, if you are a brand new option seller or just getting into it, I want you to not only set up your first brokerage account, but actually collect your first premium from the stock market. And I'm going to be showing you everything A to Z. And if you just comment down below, I'm also going to give you an accompanying ebook completely for free, no opt-in, anything like that, the new option seller guide. So if you want that full ebook, just drop a comment down below on today's video and I will personally send that over to you. But guys, today, I'm very excited for this challenge to share with you guys, right? A to Z, how to get up and running and start collecting your first premium. Now, the first thing you need to do is you need to have a brokerage account. And we have a very, 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 very special offer just for our audience here from Moomoo. You guys know I've been absolutely loving Moomoo lately. And I want to share with you guys this incredible, incredible offer that they are giving all of our viewers here. Number one, you're getting up to $1,000 in NVIDIA shares, $100 in cash rewards with a qualifying deposit. Plus, you're receiving up to an 8.1% APY cash sweep boost for 3 months. So if you want to take advantage of those incredible benefits, right, which quite literally no other brokerage is really doing, if you ask me, click the first link down below in the description of today's video, because that's the first thing you're going to need. You need to get signed up with your brokerage account, okay? Now, after you have your brokerage account set up, this is when we start getting into it, okay? So right here, obviously, I'm in my Moomoo dashboard right now, and what I want to do is I want to start researching the stocks that I actually want to get involved in. Now, for the sake of this video, I'm just going to use one of our crowd favorites, and that is SoFi, okay? Now, obviously, you can do this for the most part on any companies that you want, right? You could do this on, Pepsi. You could do this on ETFs like SPY and QQQ, right? You could do this on cheap stocks. You could do this on expensive stocks. And the thing about being an option seller is this is really a journey, okay? And you eventually, right, you'll build a good core watch list. You'll build high conviction stocks that you enjoy selling options on. And that will come with time and experience, right? I always say it takes about a year of being put into different situations as an option seller to really, get all the different kinds of situations and management under control, because we don't trade a lot. Well, we trade maybe once a month, as you're going to see, right? So let's go over the shoulder. So right here, obviously, I have my SoFi. Now, the first thing I want to do is show you guys the possibilities. Now, you do need to have money in your account. Like selling options, guys, at the end of the day, the reality of the situation is it takes money to make money. So we see SoFi obviously is trading at $28 at the time of me recording this. And let's say we actually wanted to buy 100 shares of SoFi right now, right? We can go out there and spend $2,800 and buy $2,800 worth of SoFi. Okay, you can do that, but that's what's cool about selling options is we can actually say, hey, you know what? I don't want to buy SoFi at 28. I want to buy SoFi at 26 or 25 or 24, and then I'm also going to pick the date, and then you're going to pay me for saying that too. All right, let me show you what I'm talking about. So right from here, this is called the options chain. And all we want to do here is get to the right place, right? The last thing we ever want to do is feel confused, feel overwhelmed, or click something that we should not click, okay? So what we want to do is sell a put. Now, what we are doing here is selling a cash secured put. That means you want to make sure you have the money in your account, because if you're saying you're going to buy 100 shares of SoFi for, let's say, $27, you want to make sure you have at least $2,700 of your account to be able to back that up, okay? That's called your collateral. This is putting your money to work on a monthly or weekly basis. In this example, we're just going to do monthly, but you could do this weekly as well, okay? So I'm just going to close out some of these expirations, and you could see right here, I can now select my expiration date. One thing I love about Moomoo, guys, is it shows our earnings date right from the options chain. A lot of other brokers don't do this, and it is crazy because it probably has burned you and you have no idea even why. You usually want to avoid, right, trading and selling options the week before earnings because volatility is high, and then the week after earnings because we deal with something called Ivy Crush. So first and foremost, when I look on this chain, I'm like, okay, well, earnings is right here. That means I don't want to do October 24th. I don't want to do October 31st because earnings is right smack right there at the 28th. So I want to avoid those two. I usually like to, and I usually say for beginners, go 30 to 45 days out, get into a rhythm, get an understanding, because listen, the palms will start sweating. Your palms are going to be sweating, okay, because it's just a new thing for you. I still remember the first time that I sold my first option. I was like literally shaking because I was scared, right? So, but with that said, right, it's all good. Just make sure you're clicking in the right place, okay? So right here, I'm just going to go out 30 days exactly, right? So this is November 14th, pretty much exactly 14 days on the mark. Now, when I open up this expiration date, this is where I now get to choose my share price that I'd want to own 100 shares of SoFi at. So right here, you could see I can buy it at 28, 27, 26, 25, right? And what I like to always look at when I'm here is I like to look at the delta. Now, the delta is basically, it's not, this is not the technical definition of delta, but as an option seller, it's all I really care about, is it's the chance of assignment, the chance that you would actually have to buy 100 shares of SoFi on November 14th at close, right? And this is a 24, so there's about a 24% chance that you will have to buy SoFi at that price, right? So for me, that's, I like to look at it as like, hey, it's a 70% chance or 75% chance that I'm not going to have to buy it, right? It depends on how you want to look at it, right? Now, with that said, we would collect just around, we'll just say whatever the bid is, just for the sake of this example, we would collect just about $113 of credit. Now, this is the premium, right? This is the premium that we're actually going to be collecting on this date. Now, I always like to toss everything into my my cash secured put calculators to keep everything very, very simple for me. So I'm going to just put 113 here, right? How much collateral am I locking up? Well, we said we're going to be doing our $2,500, $25 a share price, and $2,500 of collateral is going to be locked up here. And that's giving us a ROI on our collateral. Results vary, not financial advice. These are just the premiums that I'm seeing at the time of me recording this, okay, here on Moomoo, okay? So your premiums are going to look completely different, right? So I'm collecting a 4.52% ROI on my collateral. What is that number? All I'm doing is dividing the 113 divided by the $2,500 that I'm locking up for that 30-day period. Okay. Now, what kind of ROI on collateral goal should you be hitting? Well, I have no idea. I don't know what your risk tolerances are. I don't know what your investment profile is. I'm not a financial advisor. So for me personally, I think shooting around the 2% is a better play because it's a little bit safer, right? That usually when you're shooting for things over 3%, 4%, 5%, you're going to more higher risk territory. And that just means that it's just a higher chance of assignment no matter what the delta is actually saying, right? So for me, when I'm looking at SoFi right now, you could see SoFi is up 3.36% today. It's mooning. It's been on a tear recently, as we see here on our chart. Now, why does this matter, right? Well, for me, when I'm looking at this chart, and I'm just making this a little bit simpler for us to see, is I'm looking at when we're going on a downtrend, that's usually the best time to sell puts, right? And when we're on the uptrend, that's the best time to sell covered calls. Now, what's the difference? Well, what I'm showing you here on this specific trade is called a cash secured put. So that locks up that $2,500, right? And then, right, we collect that premium income up front from the options buyer. Now, there's a couple things that can actually happen on this trade that you need to be made aware of. It's very important, right? Let's say on November 14th, right, that at close, SoFi is trading at like, $30 or $28, anything above $25. Your contract expires worthless. Your premium is returned back to you, or your not your premium, your collateral is returned back to you. You're not buying the shares because it's not trading at $25. And then you could run the play again on the same opportunity or a different opportunity. Just get that, get your collateral working on something else, right? But the second thing that can happen, and this is the biggest risk that you need to be made aware of when you are selling options, is that when you are, if on the 14th at close, let's say SoFi is trading at $24 or $20, you're on the hook to buy those shares for $25. So you're not going to be at close. You're not going to be given your $2,500 back. Instead, you're going to be given your 100 shares of SoFi with a cost basis of 25. Right now, that's okay because what we can then do is sell calls. Now, a covered call is a little bit different. A covered call, you know how we locked up our collateral, right, to create the ROI, right, or to get the premium. Now we're locking up our shares. So if you own 100 shares of a company, you can actually start doing this right away. So it's called a covered call because we're selling a call against our 100 shares. And what we're saying is, hey, we're willing to sell our 100 shares of SoFi at a specific price on a specific date. Okay, so let's just use SoFi for example. Let's just pretend for the sake of simplicity here, you own 100 shares of SoFi on a cost basis of around $28, just for the sake of this example. Okay. So again, I'm going to look at the chain here, right? And again, I'm going to avoid the earnings and I'm just going to go to that same date, right? November 14th. Now here, I'm not looking at the stuff that's the strike prices that are below, right? I'm looking at stuff high because I'm not buying high, selling low. I'm buying low and I want to sell high, right? I want to lock in real gains, not just paper gains, right? So let's say I wanted to sell in 30 days my 100 shares of SoFi that I bought at $28, and I'm cool selling them if it hits $33, right? If it hits $33. Now, I always like to, that would give us, let's just say 136 of premium. Now, again, I like to put everything into my calculators here for sake of simplicity for me. I love this strategy because it's very, very simple. For me at least, I'm not a full-time trader or anything like that. So 136 of premium we're collecting. Our strike of the option, right? We're saying we're willing to sell our 100 shares for $33. Our purchase strike price is $28. We said. So again, a very juicy, higher risk premium return, right? This means that this is a very high chance that you're going to have to sell your shares at 33. Right, but if we do end up selling them, we are capping our upside here. We collect $500 in profit. Obviously, if we sell our shares for 33, and that's what our total profit will look like. Obviously, results vary, not financial advice. These numbers will constantly look different. This is just simply an educational example to show you. So let's talk about what the risks are here, though. Okay, so let's say on the 14th, right, SoFi is trading under 33, right? It's trading at like, let's just say at 28, 29, anything below 33. Your shares are not sold. Your 100 shares are returned back to you. And then you could run the play again. And I like to call it renting out the shares because you're essentially putting your shares to work and collecting a manufactured dividend from them, so to speak. But with that said, right, you can get the 30, you wouldn't sell your shares for 33. They'd be returned back to you, run the play again for the following month. Fantastic, right? Second thing that can happen, biggest risk. With the covered call, you are capping your upside like I told you, right? You're capping your upside at $33 and a max profit of $500 on those shares, right? So if on the 4th or on the 14th, right, SoFi is trading at like 50, you're missing out on all those gains. You are selling, you are locked in, and you are selling your shares at $33. That is the biggest risk. Guys, click the link below, sign up for Moomoo and collect your first premium following along here, right? You're going to get up to $1,000 in NVIDIA shares, $100 in cash rewards with a qualifying deposit, plus an 8.1 APY cash sweep boost for 3 months. So go check them out, guys. You already know, especially those of you in our private group, how much I've been leveraging Moomoo lately. I've been really enjoying, especially all the tools that they give us as well. It just makes our life so much easier. So click that first link in the description of today's video, guys. And remember, sell options, collect premiums, repeat. I'll see y'all tomorrow.